Hey everyone, this is Elijah K. Johnson with Liberty and Finance, and back with us today is our good friend Lobo Tiggre from the Independent Speculator.com. Lobo, thank you so much for joining us today.
Happy to be with you. Lots of stuff going on. Hope we can share some useful ideas with the audience.
What I first wanted to discuss, Lobo, was the what the Fed is doing right now. It seems like what the mainstream narrative is that the Fed is going to be able to do this soft landing, right, to make this the impossible happen. As we're seeing, July inflation officially, for the month of July, 0%. So it seems like the Fed's doing great, right? So, and we're seeing the stock market rally. Your perspective on what the narrative is right now and what will actually happen?
Sure. I mean, there is data there. There are reasons why people say this. And besides just saying, oh, I'm a contrarian, I don't agree. I think the important thing here, this may sound a little theoretical, but it's good to have a reason for why we think what we do. And especially if you're going to be a contrarian, we don't just be ornery. We don't just say, oh, well, we don't like the people in power now, so we're going to say the opposite of whatever they say. That's not a sound basis for judgment, certainly not for risking large sums in a speculation. And my criticism here really is pretty fundamental. I think there is a profound methodological error that most mainstream economists don't even see that they have. They have this huge blind spot. And even though the model, you've got this wave this curve, the spiral of wages and prices, and supposedly, that's part of it. You got to slow the economy to curb inflation because inflation is a product of an overheated economy and consumer confidence. So you want to bring those things down to control inflation. This is all part of a model that I just think is wrong. It is incorrect to leave money supply out of it. And Powell has said that explicitly, that money supply isn't as important as it was back in the old days when we went to school. It's all about confidence now, we think. I think that's wrong. And without getting too into the weeds of economics here, because I'm not actually an economist, my perspective is that always and everywhere, monetary phenomenon, long and variable lags, as Friedman said. And this makes it very confusing and convenient to blame other things. If that's correct, if there's a fundamental flaw, and it's not just the Fed, it's the big banks, it's the investment houses, it's the traders and their economic models, these people who trade with high frequency on the gold futures contract and the silver future contract that we mistakenly refer to as the price of gold and silver. These people use economic models. You can see it. There's a data point comes out, a CPI print or whatever, and instantly things go this way, that way, the other way based on these models. If they're all wrong, they're not all the same, but if they by and large share a similarly flawed premise or an idea of how inflation works and how the economy works, then they can get massively blindsided. And so people say, oh, well, the bond market is saying interest rates are going to peak out at 4%. Well, that's based on traders that have these models. And it's based on human beings that embrace the same error. Okay, this may all sound very theoretical, sorry, but I had to put that in there because I'm not just being contrary, right? I'm not just saying, oh, I disagree. I'm going to have my own idea. This is why. And nobody addresses this. And even when stagflation rears its ugly head, which doesn't exist in their models, you can't have stagflation, right? They still won't admit it. They won't see it. They won't even consider the possibility that maybe their methodology is flawed. So yes, I think that matters. And right now we have this mainstream methodology saying, oh, look, the Fed's beating inflation. Look at all these data points. Yay, woohoo, happy. And the economy hasn't tanked, even though we had 2 quarters of negative GDP print. We could dismiss that. Oh, that's just a technical definition. Or not everybody agrees on that definition. Look how strong the labor market is. Yeah, well, what if it isn't? And to give credit where due, my fellow Puerto Rican Peter Schiff has really been the one beating the drum on this. And I'm not sure where he gets his data. He says that there's a record high number of people getting second jobs and settling for part-time and so on. But just look at the math, the basic math that from the labor report. Labor force participation is down. Okay, not hugely, but it's down. Same time, we have a record number of jobs creation. So if labor force participation is down while the number of jobs is up, clearly people are working second jobs, or there's fewer people working more jobs. That's not a healthy thing. So many ways we can go with this, Elijah. All I'm saying is that there is plenty of clear data that suggests to me that I'm right and the mainstream is wrong. And therefore, this fantasy that we're going to have this soft landing, it's a headwind right now, certainly for monetary metals. It's a headwind right now, but I do think that the scales will fall from their eyes in due course. And that due course isn't going to be years or someday or whatever. I think we're in a recession. I think it's going to get worse. And I think that will become undeniable over the course of the quarters immediately ahead.
No, you're saying that, yeah, obviously we can take this many ways. What I would like to cover is the precious metals and what we're seeing right now. You've actually mentioned that with all the change in narrative from, oh, we're in a bull market, now we're in a bull market, we were in a bear market, now we're in a bull market is the mainstream narrative. We're, off to the races, inflation's under control. It's actually interesting how well precious metals have held up. Today we're seeing another down day, but in general, it's interesting how well precious metals have held up. Can you expand on that?
Yeah, well, the headwinds there, we've seen a dollar bounce, which has been tongue-tied today, has been very specifically this year, very directly, inversely correlated with gold prices. So, seeing gold hold on, plus or minus near 1800, maybe 1750 as you and I talk, I don't know, it's been on a retreat. But to see gold holding on in spite of very high dollar in the foreign exchange market prices, right? That's a whole nother thing. I think that's the wrong measure. The DXY shouldn't be feeding into people's buy and sell decisions on gold, but it does. And it's been doing so very strongly this year. So that's headwind number one. And then, of course, the bigger picture has always been real rates. And nominally, if inflation came down from 9.1 to 8.6, and the Fed has increased interest rates 75 basis points, nominally real rates have turned less negative. They're still profoundly negative, but the directional change matters. Those would, under previous circumstances, have been really serious blows to gold. I mean, you would think they should be, by that logic, much lower. So this tells me there's a countervailing force. I think there are people who, like us, do see the writing on the wall. And even people who don't, maybe just sort of hedging their bets. I have heard this on mainstream media. Every once in a while, there'll be some banker or analyst on there saying, we're also hedging a little bit with gold, right? It's not like they've become gold bugs or they get the thesis. But this is the Rick Roll thing, right? That traditionally over many decades, the average gold hedge in a portfolio for safety has been something like 2%. Most people aren't gold bugs. They're not stashing huge quantities of gold, but a modest 2% allocation to gold as a safety, insurance play. That's been 0.5% in recent years. And so Rick likes to say, if it goes back to 2%, that's fourfold an increase. I don't know if it'll ever go back to 2%, but even if it just went back to 1%, just 1% of the people out there saying, things are iffy. We're in uncharted waters. Who knows how this will go? Maybe a bit of gold is a good idea. I'm saying I'm hearing that. I'm not saying we're back to the 1% yet, but if it goes there, that's a double in the gold demand. So that's quite interesting to me that we haven't melted down. It's encouraging. But that's the question here is I think you're going to ask this, and I didn't quite hear it in what you asked before. But the question is, so where do we go from here? What do we do? And do we buy? Do we sell? Do we hold? What do we do? And I have done my own Lobo pivot here, as it were, based partly on this. The strength in the face of these strong headwinds in the gold and silver market has encouraged me. But the other thing was there were already lots of bargains on the table, Elijah. I think in the profoundly negative real rate market that we're in, I just don't see a major crash in gold in particular, probably not silver, though it has its industrial side. So that being the case, I was interested in buying. There were bargains on the table, but I was kind of holding back, not because of the economics as much, but just because the market just seemed to be, in general, broader markets on such tenuous tenterhooks and so skittish. I was worried that we might see another significant market waterfall event, as they say, a crash. And What's changed my mind is that not only has that not happened, but the market has taken in stride what would have been major body blows before. The 9.1% inflation didn't scare them. The Fed's rate hikes didn't scare them. The Fed's hawkish talk didn't scare them. There's so many things that in the past would have sent, if not a crash, but investors scurrying for covers. And that really hasn't happened. So never say never. I'm not saying, well, if they took all those body blows, they're invincible. But I am saying that clearly there's a risk on appetite here that's willing to disregard a whole lot of negative data or see bad news as good news. So bargains are already on the table. I was kind of afraid to scoop them up because a broader market crash puts everything on sale, even gold and silver. We've seen that repeatedly. And so I've been sort of, eyeing these bargains, wanting to buy Elijah, but worried that, if I did, they might be 50% cheaper the next week, right? And now that risk seems off the table, at least until the September Fed meeting, maybe later. The perception that the Fed is winning will go a long way to keeping markets from melting down. I've talked a lot here, but just to put a very clear point on this, I am not saying that markets will never crash this year. I am not saying that our resource stocks and gold and silver stocks can't go down from here. I'm saying that the immediate concern I had that kept me from scooping up existing bargains has now really gone away. And therefore, I'm willing to take those bargains. And if they do go on sale 50% next week or next month, I'm willing to buy more. But the risk of that seems lower now. And the bargains are there, they're now. And I've actually been on quite a shopping spree. I've bought more than half a dozen, well, some existing positions average down, some new stocks, starting with uranium stocks, but also gold and silver. So I am putting my money where my keyboard is there, Elijah.
I think that's very interesting. And it has been interesting to talk to you over the last few months. As you were saying, I'm not buying at this moment. And, what we saw was just markets fall further. And I think that was a very good call there, actually.
Wait, I have to say, lest you accuse me of being a guru, Elijah, what has happened is not what I was worried about. But because I was concerned about negativity in the market, I've been able to buy at much lower prices than I would have a month ago or 2 months ago. I'm not sure how long ago we started talking about it, but I think it's been a good 3 or 4 months that I've been holding back and I've been not buying. And so it's worked great. Whatever happens next, even if I get a better bargain, I'm so happy to be able to scoop up some of these bargains now. I just want to put that out there. I did not predict what has happened now. But because I was cautious, I've been able to execute at, I think, very advantageous prices. And I'm very pleased. I'm tickled pink.
And I think, again, one of the most important things to consider is, well, what is the value of particular companies, or what is the value of the metals? What do you believe the value is? And if it falls further, as Rick Rule often says, if you believe the value proposition when it was higher, buy more if it falls lower. So I think that's something else to keep in mind as well.
Absolutely. And part of the anti-inflation or peak inflation narrative now is, commodities have all come down, and that's showing that we've beaten inflation. It's like these people have never heard of commodities before. On what planet do commodities fluctuate down a month or two and that's the end of something? That kind of volatility can easily be repeated multiple times on the way up to a higher peak. Meanwhile, you've got a war, you've got the new Iron Curtain, you've got the green agenda doubling down on top of the war in the new Iron Curtain. You've got energy shortages, which are resulting in shortages of refined products like aluminum and zinc, things. So the outlook for the commodities themselves and their prices is actually quite strong. Now, I understand people are afraid of recession, and in a recession, commodities should go down, right? Less economic activity, so less demand for commodities. But what if that's not true this time? What if stagflation actually is real? What if all the money printing? What if the green agenda and the funding? We've got subsidies now. We've got almost 400 billion in new money just in the US for this green technology, a lot of which is going to new solar, which means copper wires and silver in those panels and stuff. We'll see how strong the recessionary factor is versus the new demand factor. But it's just a mistake to assume, like a knee-jerk reaction, that, oh, recession, commodities are going to crash. We'll see. There are many very strong demand factors. So value versus price. This is a Rick Ruleism. It's also something Doug Casey taught me when I first started. Never confuse value versus price. Markets often get overbought and oversold, and that's your opportunity when you can see the difference between value and price. The outlook, I think, despite the near-term recession, and by the way, sorry, real quick, if there is a real, honest-to-goodness, badass recession, sorry, can I say that on TV? I think the powers that be dump a bunch of money on that right away. I mean, I think there's zero tolerance for an actual recession and deflation. So even if there is that short, sharp pain there for commodities ahead, which is not a given, I think it goes away very quickly. So the value is there. I think the value is, and the outlook for commodities is very strong for years going forward, despite whatever happens in the nearest term. And the sentiment is so bearish that price is ridiculously oversold, undervalued in many cases. I think that's fantastic. The worst thing for me as a speculator is when the market loves everything I like, and they're all overpriced. And then you have to, relative valuations. Well, this junior is less overpriced than that one. So maybe it's I hate that. I want to see, gee, this company has a project worth $500 million at $1,500 gold. We're still way over that. And the company's trading for 100 million. That's a 5 times increase just to come up to a $1,500 gold price valuation. When there's objective is a strong word, but somewhat objective, net present value on the table, selling at a discount. That's when the value speculator in me gets very happy.
No, we're here again for our viewers just joining us with Lobo Tiggre of the Independent Speculator. You can submit questions. We'll answer live in the chat right there to the side. Now, Lobo, one question I did have for you, if you could kind of sum up for our viewers, what are the things that have to change in, I guess, the mainstream narrative? Because, the stock market, the precious metal market often trade based on the mainstream narrative. And the narrative right now is, well, the economy's, the stock market's going back up. Inflation is under control. What needs to change for that narrative to change?
Right. So this could take a while because it's not just, I have said before, persistent high inflation and the increasing dawning or recognition of the recession. And that's still true. I think, though, that if the persistent high inflation continues cooling, though, like if it drops from 8.6 to 8.3 or something, and then 7.9, say it's still in the low 7 range or something by the end of the year, that will really give a lot of credence to this Fed is beating inflation, even if the reality is still off. A 7% inflation rate is more than got people out in the streets in the 70s and caused such, radical changes and policy alterations back then too. So the reality will still be grim, but the narrative, I think, would be bolstered by this perception of falling inflation, even if it's still ruinously high. But if it remains ruinously high, even if lower, and the recession really becomes undeniable, I think that does cause people to stop and say, wait, something's not right here. Remember, their models, the mainstream way of looking at the world is that recession is deflationary. You can't have high inflation and recession. So they kind of see this as self-fixing. Either the inflation, comes down on its own, or we get a recession and that forces it down. Either way, it's coming down. And then, it'll be a mild recession. Look at the strong labor market. So if we see significant changes in the labor market, like if those rosy numbers from last month suddenly turn out to be less rosy, if the layoffs start happening in a big way, that I think really shakes the establishment view. If we have a third quarter of negative GDP print, if we start seeing other signs of slowing despite a high labor numbers, that shakes things up. One of the main pillars that they stand on is, oh, I don't want to hear about 2 quarters of negative GDP. I don't want to hear about GDP at all. You can't have a recession with a strong labor market. Like this, they state this like a tautology. It's a fact. You can't have a recession with a strong labor market. Well, that's not true. If everybody's working harder and getting less pay, which in real terms they are, right? That's not a strong labor market. And if there are more jobs going to fewer people, that's not a strong labor market. But even so, you could have full employment. My favorite example of this is the famous dictator Pol Pot of Cambodia declared that there was no unemployment in Cambodia. He wrote it in the Constitution. There is no unemployment in Cambodia. And they made it true. Anybody that wasn't working, they put them out in the rice paddies at gunpoint. Everybody was working. Didn't make the place well off. It didn't make for a booming economy. It was a total disaster, of course. So it's simply not true that you can't have a recession with full employment or high employment. And people may be about to find that out in the hard way. So several triggers there, but basically there are, I think, gaping holes in the mainstream narrative that should become obvious by the end of this year, or if not, in the first quarter of next. We'll see. That's as close as you'll get to a prediction coming from me. I think the probabilities are that we'll see that, but we'll see what happens.
I think what you're saying is definitely true, that, yeah, more jobs doesn't necessarily mean a better economy. And if you look at, the surveys that people are extremely concerned about inflation right now, kind of points to there's definitely a divergence or misunderstanding between what people on Wall Street think and what people on mainstream think right now about the economy.
That's true, but I have to say, I'm not just saying hooray for our side and I'm always right. It is a concern to me that it's not just Wall Street, it's not just the Fed saying, oh yeah, peak inflation, strong economy, we're going to win the war on inflation, it's coming down. They don't use the word transitory anymore, but that's clearly still what they mean and what they think. But if you look at the consumer expectations for inflation, they've come down dramatically as well. So the average Joe out there, even though they're still grumbling, I think the retreating gas prices, single-handedly, that one variable has made everybody feel a lot better. And like, oh, well, maybe they really do have this. And of course, that can turn around very quickly. Energy prices, they're non-core because they're so volatile. So it's risky to pin all your hopes on consumer expectations being down because oil and gas prices are down. But at the moment they are. And that's a real headwind, particularly for gold and silver bugs, my fellow gold bugs out there. What made the 70s roar for monetary metals was that everybody knew prices were going higher. Everybody had this expectation, buy something today because tomorrow it'll be more expensive. If it's not perishable, buy it now, right? And your bartender was talking about the gold coins he just bought, and your shoeshine boy was showing you his new silver dollar, right? That is not happening now. These consumer expectations are what's different between the current stagflation and the stagflation of the 70s. Other things are different, but this is a big thing. So if these explosions happen in the mainstream narrative that I'm talking about, Elijah, I think you will see consumer expectations change. And that should be very bullish for gold and silver.
I thought we could get this viewer's question here. This is about actually bullion exchanges around the world. And the question is, what effect will the BRICS metals markets have on prices? Now, I'm not sure I've heard specifically about a BRICS exchange. I've heard possibly a Russian one competing with the LBMA. What have you heard with regard to more metals exchanges opening around the world, and how do you think that could impact prices?
The most honest answer to this question is this is not really my wheelhouse. I'm a due diligence guy. I go out and I kick rocks on companies and I evaluate the company's prospects. And people ask me about my opinions on all kinds of other things. So I try to help where I can. We've just been talking economics, even though I'm not an economist. But I am a due diligence guy. Mining stock evaluation is really what I do. There are other people out there who follow these things better and might be better suited to answer the question. But I will say this, and perhaps useful, perhaps not what you want to hear. Things like this happen, and they make for great stories online. And if you recall, when the Basel III thing was going to be implemented, there was all this hype about how Basel III was going to send gold to the moon, that the central banks were suppressing the price so they could stock up before Basel III. And then after Basel III, everything was going to go to the moon. Well, guess what? It's after Basel III and gold is down. And there are other things like this. And it just seems like, maybe one of these days, the smoking gun will actually lead us to the body and everything will blow up and everything will change. But it seems like almost every time I hear something like this, nothing big ever happens. Another one was the Shanghai, when the Shanghai Gold Exchange was physically based, that was going to radically alter the whole gold price discovery. And I'm a big fan, by the way. I hope the Shanghai price starts getting quoted more than LBMA or COMEX, and we might see more real price discovery, but it hadn't happened yet, right? And then, there's a new thing with gold in Russia, but before, when the Russian bank started saying it was going to buy gold at a certain price, that was seen as a gold peg. Oh, it's a new gold standard. Woohoo! We're off to the races. Not so much. Rubles weren't redeemable in gold. The bank was just buying gold at certain prices. So the takeaway here is, when we hear things like this, be cautious. I would not bet the farm on anybody's new great hypothesis that, this Basel III or the swap lines or whatever is going to change everything on this deadline. You better buy before that deadline. Be cautious of that.
All right. Well, Lobo Tiggre, really appreciate your time today. We had some more viewers' questions we couldn't get to. One was about uranium, but maybe we can just quickly touch on this one here. I'm not sure if you can give specific names. I know you're if people subscribe to your website, they definitely can get the ones you're looking at there. But if you could touch on uranium, this question is, which uranium juniors would be a good acquisition target? Maybe your perspective on kind of what to look at when evaluating uranium companies.
Yeah, I got it. Because you're right. I don't give away free stock picks, and I always encourage everybody to be suspicious of people who do online. What's in it for them? Why are they telling you this? Do they own it already? But quickly, since we're running low on time, yes, super bullish on uranium. I think the special opportunity in this space, and it's close to giving you a stock pick because there really aren't that many names, is the US is clearly moving in a way that could set up special benefits for US uranium producers or US sourced uranium. So I'm not real keen on early stage exploration. I mean, by the time somebody discovers something and defines it and builds it, we're probably 2 uranium cycles down the road. But there are a handful of companies that have pounds in the ground now, even some that have mothballed production facilities and can supply the new US uranium reserve quickly. I think these are pretty obvious. Some of them are not as cheap as they were a month ago when we last talked about this, but most of them are still relatively on sale. And I think they give you extra oomph for your buck here. Apart from that, if you buy the uranium thesis, there are some top players in the space. There are some go-to names here, obviously great companies. And any of those that are relatively on sale, I think, are worth considering for a buy.
All right. Well, Lobo, we really appreciate your time. IndependentSpeculator.com. Everyone should check that out. And if they're interested, definitely subscribe. Can you share with us about that?
Oh, thank you. Well, IndependentSpeculator.com. Much to say. I'll just say, if you sign up for our free weekly newsletter, we will not spam you with advertisements every day. You get one weekly newsletter. That's it. And if you choose to do business with me on my paid services, happy to have you on, but no arm twisting on that.
All right, Lobo, once again, thank you so much for your time, and God bless.
Thank you, Elijah.